Welcome back to another edition of Pump the Brakes. My name is Andre Beckles. I am a financial consultant with Harare Wealth Management. And today is nearly forgot, March the 20th. I hope everybody is doing well. Before I start, please like, share, and subscribe to the video. Most importantly, share the video. As I mentioned previously, this is financial literacy, which means that it's information. It's free information to make you more wise about your investments or the economic field that is around us on a day-to-day basis. That being said, I want to touch on a few areas regarding last week's marketplace, the economy, Federal Reserve, financial institutions, and I think that's roughly about that. But if there's another section, I'll mention it. With that being said, last week's markets closing out March the 17th. And let's see, the S&P 500 for the week, because tech stocks had done very well, was up 1.4% year to date, up 2.4%. If we take a look at the Dow Jones, which is the Dow Jones 30 index, only 30 stocks of large-sized companies, and that was up roughly 0.15% year to date, down 3.35%. The NASDAQ, which is a more broader base index and has a lot more tech stocks inside of it, was up 4.4%, so nearly 4.5% year to date, up 11.31%. The Russell 2000, which is an index that consists of only small size companies, that was down 2.6% last week and down 1.7% year to date. And mind you, these are, as I mentioned last week, Friday's numbers, that being March the 17th of 2023. And if we look at the Morgan Stanley EFA, which is a global market index, that was down 2% year to date, up 2.4%. What sectors stand out, or stood out to me, I should say? Let's look at utilities. Last week, up 3.9%, year to date, down 5%. Financials, definitely. Everybody's heard about what's going on with many banks, not just here with some banks. Let's refrain. With some banks, down 6% last week. So it was a very volatile week inside the financial sector. And year to date, down 9.6%. The energy sector, which is down 7% last week, and year to date, down 12%. Information technology, last week up 5.7%, year to date up 15%. So tech stocks have done fairly well, or certain technology stocks have done fairly well in the early part of this year. Communication services up 7%, year to date up 15%. Oil last week down 13.6%, year to date down 17.5%. That's always a good thing, because that is also one of those triggers for inflation. And natural gas last week down 2.8%, year to date down, let's say, 43%. And let's take a look at bonds. Bonds, as far as U.S. aggregate, so it's corporate and government, that being the Bloomberg U.S. aggregate. Last week up a little more than 0.5%, year to date up 2%. Municipal bonds, those are bonds that are issued by city, states, and municipalities, that last week up just about 0.75%, year to date up 2%. And high yield, that's lower quality bonds but pay higher rates of interest. That was down about 0.25% last week, year to date up 1.6%. That information was brought to you by Bloomberg, as well as LPL Financial Research. So what else is happening? What other sector? And I took a look not at last week, but also as of today. The oil market, Western crude, that is down to like our 2021 lows. So under $70 a barrel. If you've been listening to these vlogs, there was a point when we hit 100. That was more so mid last year, middle part of last year, when inflation was roughly around, say, 9-10%. That has come back, and the reason for that is a possibility of a crisis, meaning that any type of crisis that comes about, in this case, people were very worried about the financial institutions last week. So that fear, which can lead to a slowdown in the economy and possibilities of a recession, higher interest rates. Although there was a stronger demand in China, all of these other previous factors that I mentioned weighed heavily. And also there are higher supplies for Western crude. So that helped. Higher supplies, lower demand, moderate demand, I should say. That brought the price, if I take a look this afternoon, at about $66.50 a barrel. So that definitely under that $70 threshold. So that is the data for the markets. Let's look at the economic data. Economic data is very important. The reason I touch on this, because it is something that affects you whether you know it or not. Most people, I want to say you do know what it is, because it is the most important thing as far as what I touch on that has to do with inflation or growth of the domestic or global market. So in this case, we will take a look at last week's consumer price index, which is a very good indication as to where inflation is. Basically, I call it the inflation index. And the report that came out last week for February, it was up 0.4%, and that's versus January, up 0.5%. Seasonally adjusted, meaning February to February, inflation is running at 6%, and that's versus in January when it was at 6.5%. So you can see slightly down from the month before as far as seasonally adjusted, but you do see that it is still inching up ever so slowly as far as month to month. So when we take a look at that, things that are, I like to say that are eye poppers, biggest thing was shelter. So the roof over your head, Maslow's hierarchy of needs. That's one of the psychologists. It's one of the most important things is the roof over your head. And if it costs a lot and keeps going up, that is also part of inflation. And as a consumer or as an individual or family, you always want to keep pace with that inflation, whether it be in your paychecks or the returns inside your portfolio. So the higher cost of shelter for the month of February, basically that 0.40 at shelter accounted for about 70% of that, that rise. So the report breakdown, I looked at some things that were most important to everybody. So shelter was up 8%, food in general up 9.5%, cereal, because I'm a cereal fiend, so I threw that out there, but up 14%. So I'm not eating as much cereal at this point in time. Sorry for the Cheerios, they're staying right to the corner. Ham, not in my house, but many people eat it, up 8%. Fish, up 4.6%. Eggs, this number is off the charts, up 55.4%. If you've listened to any of the previous vlogs that I've touched on, that has a lot to do with the avian flu. That's also known as the bird flu, which humans can also get. But that's where we've killed millions of birds because they have been infected by that virus. And that creates a higher cost, not just for the poultry, but definitely for the eggs itself. Milk. Oh, one little note. I heard this morning while I was driving. Dollar Tree in the United States decided that they will stop selling eggs, because it's beyond the scope of their pricing. So they're going to halt sales of eggs because definitely, if you used to think about Dollar Tree, it's not $1. And I think roughly a carton of eggs costs close to just about $5 right now. So that's out of their price point. They said they will bring back the product when prices come down. Milk up 8%, vegetables up 2.6%, coffee up 11%, sugar up 14.8%, butter and margarine up 27%, baby food up about 10%, vehicle insurance, I touched on the Y's in a previous vlog, up 14.5%. Let's jump over to the energy sector. Energy, let's say fuel, up 5.7%. Gas down 2%. Electricity up 13%. Natural gas up 14.3%. Water up 4.6%. Pet food. So if you have a pet of any kind, pet food is up 15%. Matter of fact, if you're going to the veterinarian, that cost is up roughly 10% just as well. So you're getting hit on one end or the other, whether you're feeding the pet or trying to keep the pet healthy. And let's see, transportation, as far as airlines, up 26.5%. Medicinal drugs up 3%. Spirits, so we look at beer and wine. Beer up 6%, wine up 8%. So that's the CPI report, which is very important because there is a Federal Reserve meeting that is coming up very shortly. Matter of fact, it's this week for that fact. So that is just one of the indicators that they have looked at in regards to the economy and the raising or pausing, or I wouldn't say the lowering of interest rates. Unemployment report. That also came out last week. We created 311,000 jobs in the month of February. The unemployment rate is at 3.6%, and there are about 5.9 million people unemployed. Notable areas of job growth: hospitality and leisure. I just put them together. They gained 105,000 jobs. Retail up 50,000 jobs. Government up 46, healthcare up 44,000, and construction up 24,000. Inflation factors within this report, the unemployment report, is generally one thing. Not just the jobs. Of course, it's very important to see that people are getting jobs and are employed, and that the economy is strong in one sense or another, and it is strong. But the earnings per hour, when you take a look at the earnings per hour, you'll say, Andre, why is that important? Because earnings per hour is important because as an owner of a business, if you are continuously raising the price of how much you're paying your employees, that's a good thing. Everybody wants a livable wage. Some cities, there are many big cities, you definitely need a livable wage. But as far as inflation, the reason why that this sticks out, not just to me, but also to the Federal Reserve when they're looking at inflation, they will take a look and say, well, is that being passed on in the way of a higher cost of the product and service that company is providing, or are they just eating that cost? And, it's bringing down the earnings on the company, which could also hurt the investor. So it's one way or another. If we look at earnings per hour in this report, it was up 8 cents or $33.09 per hour. So that's the unemployment report from last week. Retail sales. And why I look at retail sales, because it gives you an idea of the consumer. And the consumer makes up 70% of the gross domestic product. The gross domestic product basically is the buying and selling of goods and services inside this economy. Our economy is roughly about $25.5 trillion. That's as of last year. So if we take a look at that, it is important to use it as a litmus test or a way of looking at the strength, weakness, confidence of the American consumer. And 70% of what we do is consumption in the United States. if we look at retail sales, the spending was down by 0.4%. So that's just less than 0.5% for the month of February. Consumers spent less at restaurants, auto dealerships, furniture and home stores, department stores, and spent more on their groceries. Now, we just talked about groceries, and you know why consumers are spending more on their groceries. So that is that ripple effect. If indeed you need to stretch that dollar, or I like to say $5 a little bit further, then you may have to cut something somewhere. Of course, there's some people that don't have to cut what they're doing, but the average American will have to look at alternatives or balance their budget accordingly. And if you have either yourself or a family, you want to make sure that A, you have the roof over your head, and secondly, you want to make sure that you're providing a meal for your family. So in that case, that's the report. And let's see what else went on. I know that, I think one other thing that stuck out, which again, I heard about today as I was driving, had to do with the e-commerce sector. And Amazon is stated that in a memo that they'll be laying off another 9,000, additional 9,000 jobs. Prior to that, they've already had announced 18,000. So they are seeing a slowdown in their e-commerce business, which if you look at things from the height of where we were during the pandemic, and many people were, utilizing e-commerce a lot more. People are using it less or buying less items. And if you don't feel comfortable about the economy, it's kind of like that pulse I was telling you. You may spend less and try and hold on to more dollars in case of a retraction inside the economy. Basically, it's the fear of the unknown. Let me not spend as much in this area. Let me make sure I'm taking care of just the basics. That by and large is many households in the United States, and for that fact, throughout the world. All right, so now we're in the section of this vlog where we'll talk about financial institutions. And I'm not going to go into all the nuances. I know that you've been inundated on TV, radio, online regarding what transpired last week in the financial markets, with there being domestically two banks that were basically made redundant, so to speak. So let's look at our big seven banks. Our big seven banks: JP Morgan, Citibank, Bank of America, Wells Fargo, Capital One, Goldman Sachs, Morgan Stanley. So those are some of your large banks. The banks that had troubles last week, as you already know: Silicon Valley Bank, Signature Bank, Credit Suisse, and Republic Bank, that's still hanging out there, has not been taken over. Now, let's really talk about all four of these banks. All four of these banks are not they're regional banks, first of all, and they're generally not the bank that you generally use for the day-to-day consumer. The blue-collar worker is generally not using these particular banks. Not to say that they don't have assets of those individuals. These are generally institutions for high net worth individuals and businesses. So as we saw at Silicon Valley, I can remember I got a text last week from a friend, and she said, what are your thoughts? I'm like, well, I have many thoughts on this. But if I capsulize it very quickly, I can take a look at two of the banks because they have certain similarities, or three for that fact: Republic Bank, Signature Bank, and Silicon Valley. They're leveraged with a certain type of clientele. I mentioned high net worth individuals, small businesses as far as private banking, real estate, private equity, and startups. And her question, I'll use her name, is Stephanie. She said, so what are your thoughts? I said, well, kind of highly leveraged, meaning that they're situated, concentrated in certain areas, bad risk management. Now, these are my opinions, but if I look at things very quickly, I somewhat surmise the only reason that your bank will possibly fail or need extra liquidity is bad risk management. Something went wrong inside your portfolio or how you manage the risk at your bank. I mentioned liquidity. Well, many of these banks had runs on their money once you started hearing about regional banks or banks of the same ilk. So if you look at Silicon Valley Bank, you heard that they did a lot of lending to small businesses, but startup businesses. Then you also have another factor. I mentioned the run on cash, leverage, bad management, portfolio diversification, that being a big thing as well. Portfolio diversification, and if I can say it very quickly, many of these banks, or some of these banks, I should say, hold on to treasury securities, and they hold on to long-term U.S. government treasury securities. Not that U.S. treasury securities are a bad thing. However, they generally, banks buy long-term. Forget about how they buy because I don't want to go into that nuance. Pardon me. They have long-term securities inside their portfolio. With that being said, when you price those securities to know how much assets you have versus your liabilities, if interest rates are going up, well, it has an inverse relationship to price, meaning that it has an opposite relationship. So as interest rates have gone up, the Federal Reserve has raised interest rates 8 times. Well, the price of bonds have gone the opposite way. That's the inverse relationship. So that is something that some of these banks have had to deal with on their portfolio. Now, mind you, the portfolio that you had yesterday is not priced then at the same price today. If you look at your bond portfolio, if you have securities, you have your worst case scenario over the past year and a half, so to speak. Let's say the past year, where stocks and bonds moved in the same pace, in the same way as far as pricing. So you have bond prices going down on these long-term U.S. treasuries. And once you then say to yourself, well, what is the value of our portfolio? What is the value of our company? The same way you look at the value of your portfolio, well, it decreased for these institutions. They also had a run on money as people started looking. Institutional investors of those banks started looking at it. The Federal Reserve actually happened to have looked at it. Now, there are ways that you try to stave off the price volatility of bonds. That's called hedging. You're taking a bet on another side of another security that will make your portfolio rise. Well, I don't work at any of the institutions. I haven't talked to any of the treasurers, but it doesn't look like they did much hedging. And, hedging, I use the airline industry. Southwest used to be one of the best hedgers in the price of oil. So they would buy a lot of oil, barrels of oil, when prices were low, so that they could be very competitive, and it wouldn't be such a burdensome event in case the price of oil went up that they had to rise their ticket prices so high, and it wouldn't hurt their portfolio as much. They used to be one of the best in that area. So obviously some of these banks didn't do that. I mentioned the run on cash. Credit Suisse, which is the Swiss bank, they've had problems for years. Their issues are not new issues. It just happens to be, put under a microscope at this point in time. They have had economic issues, governance issues for quite some time. So, pardon me, every apple is not the same apple in the basket in this case. Everybody has a little something different, but when markets are down, they just say, okay, regional banks will look at those. Do they service this type of client? Well, okay, so they have this risk. Well, stock prices, we're going to bring the stock price down. We're going to examine those. You also have the scenario, and one of the last things I'll touch on is political influence. There's what's called stress tests. So I mentioned 7 big banks earlier, JP Morgan, Citibank, so on and so forth. Well, they have a more stringent stress test that they have to go through when they're being audited to make sure that they have the proper liquidity. That was created under the Dodd-Frank Act, and I believe that came shortly after the big recession in 2007, 2008. However, political influence, and if you're lobbying Congress people to have less governance and, to let the banks kind of govern themselves a little bit more, for risk, you can see that doesn't always work. Any entity will take on as much risk as possible at times, and or many entities will do that to get a better return. They don't like a lot of governance. However, I always like to say, if you want less government in your life, always expect for a shock in your life at some point in time. So this is the shock that you get when they lobby to have a little less governance on them versus the large banks that couldn't get that leeway, and this affected them. So where do we go from here? I want to say regarding 2 things. There's talk about raising the $250,000 limit on as far as insurance on bank accounts. To me, that may happen. That may happen since there appears to be widely more accounts that are out there that generally still bring money into the banks because they just trust that the FDIC will bail them out, or the government, or the people themselves. Because if you look at the situation with Silicon Valley Bank, basically, yes, the FDIC still stepped in. That's the insurance for the banks. Basically, that's a bailout. That is a bailout. In the case of Signature Bank, they're selling assets. Matter of fact, Signature Bank is now called Flagstar, which is a division of New York Community Bank here in the New York area. So they've sold off 40 branches and some other assets. Credit Suisse, as of this morning, was bought by UBS. Their larger partner in Swiss partner, and they got a great deal on that. I think it was roughly about $3.3 billion. I forget how much they had in assets. And they're also being backed up by maybe very similar to how Signature Bank was being backed by large banks, providing about $30 billion last week, basically maybe returning a little bit of the money or that money that flowed out right back to Signature Bank. But in the case of Credit Suisse, they're being backed by the Swiss government and also the Swiss banking authorities. I think that deal, as far as having facilities, meaning cash, should they need to tap at UBS, of about I think it's about $100 billion. And in that case, everybody wants to say that, the merger this morning between, or the takeover of Credit Suisse by UBS is a shotgun wedding, because the two never, ever wanted to get together for years, although it has been mentioned over the past few years that they should. All right, I think I really touched on more than I really want to touch on regarding banking. But if we touch on banking, we have to talk about the Federal Reserve. Excuse me, I have a slight cold. So this week, Tuesday and Wednesday, you have the Federal Reserve meeting. Jerome Powell is the chairperson. He's going to look at they have been looking at what's going on inside the economy, which is high inflation, some consumer confidence shocks with the financial crisis, so to speak, job market, retail sales, pardon me, consumer confidence kind of moving around like a pinball. So by the middle of this week, we'll know if there will be a pause in the rate of raising of interest rates, or a hike of 1/4 or 0.5%. I believe it'll be 0.5%. If you pause, you would have to then say that you're blind to the fact that inflation is 6%, and there are areas that certain sectors that I named out to you that are above that 6% bogey. So you have to continue to attack that. You can't wait and just assume that the consumer will stop spending, that companies that are keeping their prices high will bring prices down. So with that being said, I expect a raise of interest rates, very much so, following. How to get that water. Following what we saw transpire inside Europe, the European, the ECB, the European Commission, the European Central Bank, pardon me, which the president is Christine Lagarde. So last week, I believe it was Friday, yes, Thursday or Friday, they raised interest rates by 0.5%. And if I take a look at her words, inflation is projected to remain too high for a long time. So that's the reason. She said their banking system is strong and they are always prepared to step in if indeed necessary. So even with the situation at Credit Suisse, and if you're in Europe, you've definitely have been aware of this situation with Credit Suisse for quite some time. So her thing is, as far as the ECB, raise interest rates to cool the economy and create price stability, meaning bringing prices down. I only see the Federal Reserve doing the same. Also this week, you have the Bank of England. They too could be anywhere from 1/4 to 0.5%, or a pause. A pause, I nearly say something about the Bank of England, but I'm going to say that they'll do something. I can't see them pausing, because to pause is to act, like I said, that inflation isn't out there, and it is. What else? Recession later on this year. Is that possible? Well, I know that if you've been listening to these vlogs for quite some time, you've heard me talk about the canary in the coal mine, and it has to do with interest rates. If short-term rates are higher than long-term rates, at some point in time, there's going to be a recession. The fortunate thing in the United States, which is a good thing, is that we have seen that unemployment has stayed low, and we have seen the drop from that 10, 11%, and inflation come down to 6%. That is a great thing. So with that being said, there's still more work to be done. That's why I mentioned that rates will continue to have to go up in the short end. But if I look at the 2-year Treasury, and that's here on the 20th, this afternoon, I saw it was at 3.98, so just under 4%. It was just a few days ago, it was close to 5%. Interest rates have really been fluctuating. You'll say, well, that stock price, it's a little bit low. No, bond yields do not move that much. That is a lot. But 3.98, the 10-year at 3.47, the 30-year at 3.6. So if you see the latter are lower than the short term, the 2-year, that is your canary in the coal mine saying a recession is somewhere there. Now, we've already had numbers on GDP that show the technical recession, but numbers that kept coming out, retail sales, consumer confidence, unemployment, were all positive, still trending positive previously. So I'm hoping it doesn't happen, but I have to look at the numbers, and numbers don't lie. With Sheet Wallace, right? Numbers don't lie. People lie. People know that. All right, so let's close this up. So what's going to happen in the next few days? Well, you have the interest rates that I talked about. You have other economic data that will be coming out, but more personal to everybody that's listening, you'll have your investment statements, whether you're getting it from me or you're getting it from your 401k plans, where pension plans, so on and so forth. You're going to see the changes inside the marketplace. If indeed these are long-term investments, yes, you check your portfolio for what you own, and you want to make sure that the risk that you're dealing with fits the person that you are. So that's your risk tolerance fits who you are. If you're a client of mine, by all means, you give me a call. We have been doing reviews, and we'll continue to do reviews over the next few days. Also, technically about a month away, 4/18, I believe it is the tax filing deadline. It's not the 15th. There's a few extra days kicked in. So with that being said, you still have time to make 2022 IRA contributions. So if you didn't max out your IRA contribution for 2022, you still have time to do so. So whether you're working, you have to be working, you have to have income, or if you're not working and you're a spouse, and you can have a spousal IRA, go back to the retirement plan video that's here on YouTube, and you can listen to that. Or if you're self-employed. So the maximum contribution is $6,000 to an IRA. So that's whether it be a traditional or a Roth. Or if you're 50 years and older, it's $7,000. If you're self-employed and you have a self-employed IRA and you haven't made a contribution, you can do anywhere up to 25% of your total compensation, up to no more than $61,000, whichever dollar amount comes out to be lower. So that's very important. One other thing that sticks out, you may start hearing a little news about banks that are circling around Republic Bank. One name that pops out is PNC Bank, possibly interested in buying some, if not all of the assets, to be determined. And let's see, I basically stay the course. Hate to sound like Ronald Reagan, but stay the course. If you're a long-term investor, if your portfolio meets your suitability, meaning that it meets your risk of who you are and where you need to be right now, and also going into the future, stay the course. We do have blips from time to time, and that is something that you have to deal with. I always like to say, prior to last year, if you were a new investor, every year of the market being up in the past few years was a great thing. There does come turbulence every now and again. That's why I say there's ESP. It's called not ESPN, but ESP, economic, social, political, and then the unknown. The unknown is whatever can happen on any given day that we weren't looking to see happen. So with that being said, I'd like to stop, remind you to like, share, and subscribe to this vlog. Most importantly, like, share, and subscribe. The more you subscribe and like, the more that it goes out into the stratosphere. But most importantly, this is financial literacy for not just my clients, or for anybody that wants to listen to this information. So I have no further words, but peace be with you until the next time we speak. Take care.